everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining me today. As always, glad to have you here. All right. Should I buy the dip? What do you think? We're going to talk about that today. And again, as the description implies, this is not your favorite salsa or a party dip. We're talking about dips in the stock market. See what I did there? So should I buy the dip? The reason we're talking about this, or the reason I'm talking about this, is because we're talking about this. There are many people talking about this right now. So depending on when you listen to this, right now, as I'm recording this, the market is a little bit choppy. We've seen some ups and downs. We're currently seeing some downs from where the market was previously, earlier in the year, even or last year. Actually, I shouldn't say last year. That's actually not true. The market is generally trending up from last year, but we're seeing little dips. We're seeing little ups and downs and peaks and valleys and things kind of bouncing around, and that makes people kind of pay attention. The smoother the market is, what I've noticed is the less people care about it and less people talk about it. The choppier the market is, the more people pay attention and get interested in it, which is interesting. So we're seeing the choppiness lead to some conversation, and have been asked more than once recently, should I buy the dip? So what does this mean, buying the dip? Buying the dip, I'm going to break it into kind of two segments I'm going to talk about, but generally buying the dip means buying at a low point in the market with the purpose of taking advantage of a lower price point, or so buying investments, stocks, mutual funds at a lower price, so that you're kind of buying them on sale, so to speak. I'm going to break this into kind of two philosophies. The first approach in buying the dip is waiting to invest cash until you see a dip. So basically kind of hanging on to cash, saying, you know what, I have a threshold. I'm going to hang onto this cash and I'm going to look for a dip in the market. And when I see a dip, I'm going to buy then. I'm going to actually invest at that point to kind of get things on sale, so to speak. The other kind of approach that I'm going to talk about a little bit is investing cash that is ready for investment, and you just happen to think, hey, it's a good time, I'm going to invest it because the dip is here, or there is a dip, or the market seems down, so I'm going to go ahead and do it now. That is a different kind of approach. I'm going to talk about both. So let's talk about the first approach, where you're actually waiting to buy the dip. You've got some cash and you're purposely waiting to buy when you feel there is some kind of dip in the market, or when it's low enough that you feel comfortable investing. So this is often based on threshold. So often people will say, you know what, I'm going to wait until the market's 10% down or 20% down or 50% down or something. They'll have a threshold in mind and they will invest based on that threshold. So can this work? Yes and no. So sometimes buying a particular dip may end up beating the tried and true steady dollar cost averaging approach. Dollar cost averaging is basically investing money every month or periodically at a certain time period, just like clockwork on a recurring schedule, month over month over month, or week over week sometimes, or whatever the frequency is. Typically it's monthly. So will buying the dip beat dollar cost averaging? Sometimes, not the majority of the time, but sometimes it will. So that is a factor. However, when it does beat dollar cost averaging, it doesn't beat it by much. It's not that significant. There are many studies out there. One case study kind of showed a 5-year period of, do you invest the low point in the market, the high point in the market, or dollar cost average throughout the year? And the difference is less than 1% of performance return. So it just really depends. But in general, the probability that you will beat dollar cost averaging by buying the dip is low. It's not the majority of the time. So, and the danger of this approach, more importantly, is that you may never get the dip you're looking for. Let's say your threshold is 50%. Let's say your threshold is, you know what, I'm going to invest this chunk of money when the market is 50% down, and that's my threshold. So I'm going to wait it out. I'm going to wait for that dip. Well, if you'd followed that strategy from 1980 to 2000 with a 50% threshold, you would have sat in cash the entire 20 years while the market just kept going up and up and up. So what that means is that particular strategy would have caused you to lose out on 20 years worth of returns because you never saw the dip you were looking for. You never met that threshold. So that's one danger, is that it causes you to sit on the sidelines longer than typically is advantageous for you. Another issue is, even if you do get a dip, it still is going to come at a cost typically. So for example, let's say you decide that you're not going to buy until there's a 20% dip in the market. Okay, fine. You're sitting on cash. Your threshold is 20% down. So imagine if the market doubles with no dip, and then let's say it then immediately drops 20%. You've met your threshold. You invest the money, but they're still 60% above where they were when you first started investing or first started like making this intentional decision. So when you buy the dip, you're not buying a 20% discount. You're buying at a 60% premium. Whereas if you had just put the money in to begin with at the beginning of this whole process, you'd still be better off. So if you do get a dip, it's not always what it's cracked up to be, because you're still delaying that investment, and the dip you see may still be higher than where you started. So just because you're seeing a low point in the market or a drawdown doesn't mean that's the best time to invest. So that's one of the risks of the buy the dip strategy if you're hanging on to cash and waiting for that threshold. So let's take a look at the other approach, which is to use it as a reason to put cash in. There's nothing wrong with this if it fits your plan. If you got cash sitting around, you're kind of thinking, I'm going to invest it at some point. Great. If the dip comes along and it looks like the market's down a little bit, there's a drawdown and it gets you to invest it, go for it. If it fits within your plan and it's the motivation you need to do it, then yeah, go for it. That can be a great thing. So there's nothing wrong with that. Generally, whatever gets you investing earlier is a good thing. So if the dip makes it happen, go for it. So bottom line is dollar cost averaging is usually the most reliable way to see the growth that you want to see and overcome unforced errors that are driven by emotions. When you're approaching a buy the dip approach, you're generally setting yourself up for unforced errors. That's kind of a tennis term. I play tennis. And so unforced error means kind of an error that's brought on by yourself or your own emotion. So we want to avoid that. So my advice, set up your investing on monthly recurring contributions. Dump extra cash in when you have it and makes sense within your financial plan, and keep it simple. I wouldn't worry about buying the dip. It's going to cause lots of other issues typically. So I'm a big fan of setting up dollar cost averaging on monthly recurring contributions and letting it run. And you're typically going to be better off that way. So great questions people are asking. I want to address that today and kind of talk through it. So with that, if you'd like to talk about this or anything else, feel free to reach out. My website is elevationfinancial.com. Feel free to book a money session using the homepage button there you see when you get there, and I'll be happy to chat. So as always, thanks for joining me today. Have a great day. We'll see you next time.